All right, let's take some time and talk a little bit about the primary and secondary market. As you know, the primary market is where an issuer is going to receive the proceeds. So let's say, for example, ABC Corporation is going to go public in selling their stock to the investing public. So in this case, when they do their IPO, for example, then they would be selling stock, customers would be purchasing it, and the money would go directly to the issuer. Once that has taken place and there's the investing public owning those shares, then when those people sell their shares, they're not selling them back to the issuer, they're selling them to another investor, in which case the investor who previously owned those shares would have received the proceeds from the sale. So in the primary market, the issuer gets the proceeds, and in the secondary market, another investor would receive the proceeds. So keep that simple thought in mind, and that's very, very helpful in answering a lot of questions moving forward. Here we have an example of what we call Rule 5130. Rule 5130 is, pretty basic. They talk a little bit about it in a different section in the book as well. But the idea is that the first time that the corporation, like ABC Corporation, as I had mentioned, or MIJ Incorporated, right? First time that they're doing their IPO, the first time they're needing to raise that capital, they're issuing securities out to the public. This rule applies. And what it says is that nobody that's considered an insider would be permitted to be able to make a purchase during the IPO. We'll get a little more into that in just a moment, but I want to point out that an APO, which is called an additional public offering, this is when the company has decided to do the IPO, but they haven't issued all of their shares. That's actually pretty common. So they keep some shares in-house. Sometimes we call it keep them on the shelf, right, for a later date. When they do an APO, this rule would not apply. This is when the company wants to raise additional capital at a later date. This isn't during the IPO. Okay, so let's talk a little more about Rule 5130 when I say an insider. This would include any of the member firms that are involved in the offering, as well as any of their employees, any finders or fiduciaries that are involved in this offering, the portfolio managers, as well as anyone that owns greater than 10% of a company's voting stock. Now, to just add to this, and you'll hear me say a lot of times as you work with me, the devil's in the details. Okay, so here we have a devil in the details. In addition to all these people we've just talked about that would not be permitted to make a purchase during an IPO, according to Rule 5130, it also extends this rule to include any parents, in-laws, spouses, siblings, or children. So any parents, in-laws, spouses, siblings, or children of any of those people would not be permitted to make a purchase during the IPO. Now it goes one step even further, and it says that if any of those people, if anyone anywhere is receiving any type of material support from any of those people, then they're not allowed to purchase during the IPO either. I usually use the example of an ex-spouse, right? This says spouse, but what about my ex-husband or my ex-wife, right? In this case, would they be allowed to make a purchase? Well, that would depend. Are they receiving material support? Are they getting alimony, or are they getting child support, in which case they would not be able to? Now, when we talk about issuers in the primary market, we talk about corporations, the government, and municipalities. Before we go any further, I just want to point this one important fact out. Corporations can issue both equity and debt, But the government and municipalities can only issue debt securities. They are not able to issue any equity securities. Think about it. Equity securities is essentially when an investor is getting a little bit of ownership in the corporation. I always use the, metaphorically speaking, a building. And imagine if every share was a brick from that building. Every time that you make a purchase as an investor in a share of stock, you're buying a brick from the building. So you have a little bit of ownership in that company. Whereas the government in a municipality would not be able to sell a little piece of themselves because essentially who owns them? We do, right? The US taxpayers. We own the government. We own the municipalities. Now, let's say that there's an underwriting that takes place. We're going to talk about types of underwritings in just a moment. But let's say that there's a type of underwriting that takes place called a firm commitment, in which case a investment bank, essentially as acting as an underwriter, would be buying all the shares that I'm trying to raise for capital. All right. So let's say that I want to issue 100 million shares. Then this bank would buy all those shares from me, and I'd have my fat piggy bank and I'd be all set. I have no more risk in this as the issuer. I've raised every dime I wanted to raise. A syndicate would be formed. This is a group of broker dealers, investment bankers, and other underwriters that are formed to assist the issuer in offering those securities. Then there's something called a selling group that the syndicate will put together, which can consist of multiple broker dealers. But those broker dealers, the ones in the selling group, would have no financial commitment at all. Firm commitment, the syndicate has purchased all the shares from the issuer, as I just mentioned. And then there's another type of underwriting called best efforts. Best efforts can be as a mini-max or an all or none. Mini-max is pretty much what it says. This is the minimum amount that we'll sell with no more than this as a maximum, versus all or none, meaning we'll do our best, right, to sell them all. But if we can't, then we're not going to sell any of them. So in a best efforts, the syndicate is just simply agreeing to do their best to be able to sell the shares. So here we have an example. MIJ Corporation would like to raise 100 million. They've been advised to offer stock to the public. ABC will enlist the help of investment bankers and broker dealers to underwrite that offering. That would be the syndicate. And then, of course, the syndicate would put together the group, the selling group. So just so you can visualize or, take a look at how that could happen. Now, when we talk about the investors in the primary market, we have our institutional investors, our retail investors, and our accredited investors. Our institutional investors, you should just kind of make a side note. This is typically any entity that has 50 million or more in assets. It could be entities with hundreds of millions of dollars, but 50 million is pretty much the break point where it shows that they're institutional. So like our banks, our insurance companies, pension plans, mutual funds could all qualify as institutional investors, as well as anyone who is running those. Like the CEO of the bank may not have $50 million, but they're running an entity that does, therefore they're institutional. The pension plan, the person who's actually running the pension plan, in charge of it may not have $50 million, but they're running an entity that does. So they would be included. Many times these are referred to as non-retail, institutional, non-retail. Then we have our retail investors. This is the average investor, like you or me. We're not savvy, so to speak. Now, I always say, and maybe just in a loss of better words, these are kind of the dummies of the investment world. So we have to be treated as such. We have to be given full disclosure of any risks that we might be encountering when we do our investments. Okay, so a retail investor is like you or me. By the way, this includes a day trader. The only difference between me and a day trader is that day traders don't hold a position open. They'll close their positions typically every day, right? Versus me, I opened my IRA when I was 19 and didn't make a change till I was almost 40. Then we have our accredited investors, and accredited investors have many different names. We also refer to them as sophisticated investors. We also refer to them as qualified investors, and sometimes we call them savvy investors. So accredited, sophisticated, qualified, and savvy would all be words to describe this classification of an investor. This, of course, includes those institutional investors, as well as any insiders, as well as any issuers. It also could include an individual if they have $1 million or more in assets, not including their primary residence, or not and, if for the previous 2 years they've made $200,000. They file single on their taxes and they intend to make the same this year. Or they're married, filing jointly. They've made at least $300,000 for the previous 2 years and intend to make the same this year. In any and all of those cases, an individual could be deemed as accredited, sophisticated, qualified, savvy. All right, so one of the very highly testable things that you'll run into on your exam is something called the S1. The S1 is the registration statement that is required for anyone who's non-exempt to file with the SEC in order to begin to market securities, to be able to have an IPO, okay? So what happens is we go ahead and file that S1, that registration statement, and then it automatically enters what we call the cooling off period. This period is a minimum of 20 days. Now, those 20 days could be paused if there's a deficiency in the S1, in which case, let's say we're in our 8th day, the SEC finds a deficiency. They'll return it to the issuer for the corrections to be made, so that once the corrections are made, we would continue in that 20-day cooling off period, okay? So it's a minimum 20-day cooling off period, which obviously could take weeks, months, right? During that cooling off period, there's some things we can do, some things we can't do, and we're going to talk about those in just a second, okay? Once that cooling off period is complete, the SEC sets what we call an effective date. On the effective date, we must have a full prospectus available to be able to hand to a customer. So let's talk about what can and cannot be done during this cooling off period. During the 20-day minimum cooling off period, we have to distribute what we call a preliminary prospectus. This preliminary prospectus is sometimes referred to as the red herring. As you'll notice, I do a lot of that, right? That also known as. Those are our synonymous terms. Guys, we need to pay special attention to those because it is not uncommon for FINRA to use multiple terms to describe one thing. And of course, we need to be familiar with the terminology, the lingo in the securities industry. These are the essentials, right? So we need to be prepared in doing so, in studying. So we distribute the preliminary prospectus. This is also known as the red herring. This is the very minimal information that we know. In fact, there's 2 things that will never be in the preliminary prospectus, and this will include the price and the IPO effective date. So the IPO price can never be in there. The IPO effective date could never be in there because we simply don't know them yet. We are able to publish advertisements, but these advertisements are known as a tombstone ad. sometimes called the bare bones facts. Get it? See what I did there? The tombstone ad, the bare bones facts about the offering. Okay, so we publish those during that time if we choose to. During this time, we cannot accept any orders. We can't accept any money. We can't accept any binding indications. We can't solicit. We can't disseminate sales material. None of that can be done. The only thing we can do during this time is gather indications of interest from potential investors. All right, guys, here's a little note that it's important that you're familiar with concerning the full prospectus. The full prospectus must be given to a customer in the situation of an IPO if it's an NMS, exchange listed security. Now let's talk a little bit more about that before I get more into this fact. Okay, NMS is National Market Securities. These are those that are listed on the exchange, like the New York Stock Exchange. This is part of our secondary market, of course, we know. If I am purchasing one of these, which by the way are also referred to as non-redeemable, okay? So NMS listed, exchange listed, non-redeemable, any of those words could be used to describe this. If I'm going to make a purchase during the IPO as an investor, you would be required to give me a prospectus within 25 days. So let me rephrase that. I don't like the way I said that. I apologize. I would be required to give you a prospectus if you made a purchase within 25 days of the IPO. That's more like it. I apologize. And then, of course, an APO, you wouldn't be required to give me one at all. Now, another part of the secondary market we call the over-the-counter market. This is also known as non-NMS or over-the-counter, sometimes referred to as OTC, sometimes referred to as negotiable. In the case of me purchasing a security that's non-NMS, if I'm purchasing in the IPO for the first 90 days, I'd be required to be given a prospectus. If I'm purchasing in an APO for the first 40 days, I'd be required to receive a prospectus. So it's important that we understand that information about that registration statement. But what's just as important, if not more important, would be understanding who is exempt from having to register. So I want you to take note. There's certain securities that are going to be exempt. There's certain issuers that are going to be exempt. And there's certain ways that we issue securities that would be exempt. So let's first talk about the issuers that are exempt from having to go through the process that we just discussed, that filing the S1, the registration statement. Who is exempt from that process would be our US government, as well as any of their agencies. The municipalities would be exempt. Any charities and religious institutions, often referred to as 501c3s on our exam. Banks would be exempt, as well as common carriers such as railroads. Those are all issuers that would be exempt from having to file the S1. Then we have securities that are exempt. Those securities would be CP, also known as commercial paper. These are used during periods of high interest, in which case a corporation would borrow money from a bank. These are to cover short-term needs. Also, BA or banker's acceptance. These are used in the import-export business. I always use this example. If I'm a wheat farmer in Idaho and I'd like to export my crop of wheat to a buyer in Europe, Europe doesn't want to send their money to me until they have their wheat. And I don't want to send my wheat until I have my money. So the banker's acceptance is the go-between, the middleman. I always say it's like the PayPal. for import export. Okay, so that's a BA, a banker's acceptance. Both of these are very short term, very high quality products. As you can see, both have maturities of 270 days or less. Now let's discuss the way that securities could be issued that would make them exempt from having to file the S1. The first of which is known as Reg A, or Regulation A, which is for small and medium-sized offerings. Now, these may not seem small, right? But when we think of the fact that a large cap company is worth 10 billion or more, then that makes a little more sense. It's like a dime in our wallet, right? So under Reg A, we have Tier 1 and Tier 2. Tier 1 has a max of 20 million in a 12-month period of time. Now, Tier 2 has a max of 75 million in a 12-month period of time. But please note that Tier 2 must be all accredited investors. Remember that? We talked about it just a few minutes ago. Accredited, sophisticated, qualified, savvy. Tier 2 requires all investors to be accredited in order to fall under Regulation A, with this offering not having to be registered. Another way that securities could be registered that would allow them to be exempt from, issued, but that would allow them to be exempt from the S1 filing is what we call Rule 147, sometimes referred to as an intrastate offering. Now, here you can see it's when offerings only take place in one state. They have to follow what we call the 80% rule. So 80% of the company's proceeds, the sales, anything that this offering is going for would have to remain in the state. Even to the point of where whoever's purchasing the securities must be residents of the state. Now, there is a part of this rule that says that when a resident of the state purchases under Rule 147, they would have to hold that security. We call it a restricted security. They'd have to hold that security for 6 months before they'd be allowed to sell it. And at that time, they could sell it to anybody, including a non-resident. In Unit 2, we'll talk more about those restricted securities, and we'll refer back to Rule 147 at that time. Another way that securities could be issued that would allow them to be exempt from the S1 registration is what we call private placement. Private placement, unlimited amounts of capital can be raised. There's no cap on how much can be raised. In private placement, it falls under a regulation known as Reg D or Regulation D. Essentially, it's when the issuer is gathering their own investors. Sometimes we refer to this as lettered stock. And lettered stock is sometimes referred to that way because you have to sign a special letter or form stating that you understand the risks involved. It's also sometimes referred to as legend stock because on these stock certificates would be a legend or a statement that reads that this is unregistered, that this is a private placement. Now, knowing that Regulation D is private placement, we have to know the bylaws or rules that exist that enhance it, known as Rule 506B and 506C. 506B was the original rule, and it is still available to be used, which says that any securities that are issued under Reg D are exempt from registration and are allowed to have up to 35 non-accredited investors. We are not allowed to solicit or advertise under 506B. 506C, which came with the Jobs Act of 2009, any securities that are offered under Reg D are exempt from registration. But all purchasers must be accredited, sophisticated, qualified, savvy. And of course, the business that's offering the securities must take reasonable steps to verify that each purchaser is accredited. So when we take a look at a snapshot of what type of offerings we're talking about, if we have an investment banker selling to the public on behalf of an issuer, that would be a best efforts underwriting offering. An underwriter selling IPO shares from its own inventory, that would be a firm commitment underwriting offering. ABC Corp selling 15 million in bonds. This would be Regulation A, Tier 1. Buy Stuff Inc. selling 45 million in preferred stock. That's Reg A, Tier 2. Sierra Verde Coffee offering shares exclusively to residents of its home state. We know that that would fall under Rule 147. And Little Jim Corp offering shares exclusively to accredited investors. That would be private placement. So as you can see here, the first two offerings are not exempt. They're just ways underwriting can be done in an offering, whereas the others would all fall under exceptions or exemptions from having to file the S-1. All right, moving into the secondary markets. Guys, I always explain it like this, okay? I always say that the secondary market is unidentical twins. We have the exchanges and we have the over-the-counter. They're unidentical twins, but they're both part of the secondary market. We have the physical location known as the exchanges, where listed securities will trade. There's about 13 exchanges in the United States, but our industry standard is the New York Stock Exchange. So you'll see almost every question based on the New York Stock Exchange, the NYSE. Okay, that's the physical location, also known as the auction market. Remember earlier I said these are NMS securities. These are listed securities, sometimes referred to as non-redeemable securities. Here's an example of how the order would flow in the event of a trade. Customer A contacts their broker-dealer. Because they're assisting a customer in a purchase, they're going to possibly send that down to what they call their floor broker if it's a complicated trade. The floor broker will then go ahead and contact the DMM, the direct market maker. They're going to make sure that they get those securities purchased on behalf of customer A. The DMM will mark those trades and report them to the consolidated tape, allowing the whole world to know the trade has occurred. How they will make sure that those securities are bought is through another broker dealer, who of course would be selling on behalf of a different customer. Okay, so customer A wants to buy. This is the process that's done in order to buy from a customer that's selling. Now, there's two other in this process that I want to explain. One's called the floor trader. There's somebody called a floor trader that if they're down there on the floor of the exchange, they're doing business on behalf of the firm, not on behalf of the firm's customers. And then there's something known as a $2 broker, which is somebody that can be basically hired for the day. They don't get to share in any of the commissions. They're just going to be paid a set fee to assist the floor trader or floor broker for the day. Here we have the unidentical twin of the secondary market known as the OTC, the over-the-counter. The over-the-counter is also known as unlisted securities. Typically, unlisted stocks and most bonds, like your corporate bonds, municipal bonds, and government bonds would be traded here. We call this the negotiable market, the non-NMS. This is not a physical location. Rather, it's a computerized bulletin board. It's a quotation system. Dealers buy and sell a security from their inventory to provide liquidity. Then we have our third market. Our third market, much like the primary market, only exists for one purpose. The third market exists in the event that a non-redeemable security, a listed security, would like to negotiate a trade. If they want to trade over the counter, they are permitted to step into the third market in order to accomplish that. I always say, but it's their job to get their butt right back over to the exchange. Then we have the fourth market. The fourth market we often refer to as the dark pool of liquidity, or just the dark pool. And the reason we call it that is because this is the ECN, the Electronic Communication Network. It takes place 7 days a week, 24 hours a day. This is banks trading with banks and mutual funds with pension plans and, the FRB loaning money to the banks. We don't really have a place that we can go and see that happening. That's the fourth market. Often we say it's where institutional trading occurs. So out there in the secondary market, we've got our investors, those that are buying and selling securities for themselves, whether it's a retail investor, also referred to as a day trader, as I mentioned earlier, just not keeping positions open like a day trader, or excuse me, not keeping positions open like a retail investor would. Any accredited or institutional traders or investors as well as any investment advisors or any fiduciaries for a customer. And then, of course, we have our broker dealers. Broker dealers are going to either act on behalf of themselves, in which case they're acting as a dealer, or they'd act on behalf of a customer, in which case they'd be acting as a broker. It's important to note that a broker can never act as a dealer in the same trade. A dealer can never act as a broker in the same trade. It's a conflict of interest. Often they're referred to as introducing firms and clearing firms. Now, let me take a moment and back up a little bit and explain the broker-dealer a little bit more. So there's a video there and it doesn't play on, when I do the Zoom. So you only really get to see those in a live class, but no big deal. Okay, so a broker-dealer. If we're thinking of a broker, imagine a real estate broker. They're going to take someone around to different properties so that they can see them in order to decide what home they'd like to purchase. But as we know, the real estate broker doesn't actually own any of those homes, do they? That's the same way a broker acts in the capacity of helping a customer in order to achieve a transaction like buying or selling. They don't actually own the securities that they're selling to that customer, nor are they going to buy the securities that that customer is selling. Rather, they're going to assist them in finding another investor in the secondary market that will buy or sell. Whereas a dealer, imagine going to a car lot, a car dealership. When you pull onto the lot, you see many different vehicles there, don't you? All of those vehicles were purchased by the dealership, whether it was from an auto auction, the manufacturer, or maybe another person. When the dealer purchases the cars, they're going to pretty them up, right? I always say they put lipstick on the pig. And when they do that, they're going to mark up that price. Now, when you make the purchase of the car, you're actually buying from the dealership that owns the security, and the dealership is going to make money by marking up the price. Okay, so that's the broker versus the dealer, to give you a real world idea of how they work. We also have something called a prime broker. Guys, there's not a whole lot you need to know about a prime broker for your test, but typically if it's mentioned, it's for a hedge fund, usually, okay? These are usually your accredited investors. And what they'll do is they'll get an account with one broker, a prime broker. And that prime broker's primary job is just to hold the assets, keep track of all the information, distribute dividends and capital gains and interest and things like that. They don't actually usually perform any of the transactions, but it assists a customer in being able to do business with multiple broker dealers from one account. So the prime broker is where the account is held. The executing brokers are where the transactions are occurring on behalf of that one account. Here we have some terminology. Custodians. For the purpose of this test, when you see custodian, you should think right away of an adult taking care of a child's assets. They're the custodian over the child's assets. When we see trustee, typically it's referring to an adult overseeing another adult's assets. They're the trustee over an adult's assets. There's some other fiduciaries that they may talk about, like a limited power of attorney versus a full power of attorney. A limited power of attorney states that you can make trading decisions on behalf of a customer within an account, whereas a full power of attorney would allow both trading decisions as well as withdrawal of securities and/or cash. Now, in either case, if it's a durable power of attorney, it will allow the person to remain in that power if the grantor has become incapacitated, a coma, Alzheimer's, something along that lines. You'd still have that same power of authority. However, once the grantor has passed, once they're deceased, then there is no longer any power of attorney. It stops at that time. Then we have transfer agents. Transfer agents are set up for customers' accounts as far as all their information being held at the transfer agent. The transfer agent is typically in charge of issuing and redeeming shares for a mutual fund. The transfer agent is who will disperse interest and dividends and capital gains. And all the customer's information will be there at the transfer agent, their contact information and tax information. There's not much you need to know about an IA for this exam, but an investment advisor, an IA, is one who receives a fee for their advice. So it makes them much different from the registered rep. An IA is covered under the Investment Advisor Act of 1940, and you'll learn much more about them for your Series 6, but that's about all we need to know here for our SIE. And then, of course, depositories and clearing corporations. There's several of them out there. The OCC is the Options Clearing Corporation. We have the DTCC, which is the Depository Trust Clearing Corporation. There's so many out there. And, you know, reading in your LEM, you'll get to see a little bit more about them. But essentially, they're the ones who are going to clear the trades. All right, let's go ahead and cover placing a trade. Now, when we're talking about the bid and the ask, please note that this is only referencing the dealer. When we say bid, it's the highest price that they're willing to pay to purchase a security. And when we say ask, it's the lowest price they're willing to accept to sell the security. So a bid is when I'm buying. B bid, B buy is always B below the ask price. That's how I usually teach it. B bid, B buy, B below the ask price. The difference between the bid and the ask is just simply the spread. It's the profit that the dealer, also known as the market maker, is going to make in this transaction. Now, sometimes you'll see something that looks like this, okay? It'll have 93.25, and then it might have 2 by 3 on there. Okay, all this is referencing, if you take a look, we've got the bid of 93.25, the ask of 93.50, and then of course the spread between them is 0.25. That's the profit. 2 times 3 is just referencing what we call lots, L-O-T-S. 2 is referencing 200 lots. 3 is referencing 300. 1 would be 100. 4 would be 400, right? Now, sometimes we'll see multiple of these in one place, like a list of them, and it'll ask what the inside spread is. All we do is find the highest bid and the lowest ask, and the difference between them would be what we call the inside spread. If we talk about a market order, we should know that this is something that would be executed immediately at the best available price. I contact my broker dealer and say, please buy me 300 shares of ABC Company's common stock. In this case, that's a market order. I've said nothing else, just buy me that stock. They're going to go ahead and execute that trade for me. However, they can't guarantee what the price will be, even if it was $32.14 a share when I called. As we know, watch any stock price, it's fluctuating consistently throughout a day. Then we have something called a limit order. This is a pretty simple concept. If I say, I would like a buy limit of 30, what I'm saying is, I want you to buy me 300 shares of ABC at $30 or less. Don't pay more than $30 for them. I've limited what I'm willing to spend, a buy limit, versus a sell limit, where I say, sell my 500 shares of ABC with a sell limit of 20, meaning you can sell all of my shares that I've directed you to sell, but don't take less than $20 for each share. You see the difference between a market order and a limit order. One, I've just told you what to do, buy or sell. Whereas a limit order, I've said, buy at 30 limit or sell at 20 limit. Then we have something called a buy stop or a sell stop. Now, what this does is it's an order that's placed that doesn't become a live order until it hits a stop price. A buy stop or a sell stop, we'll use the same example I used just a moment ago and say, let's say I do a buy stop at 30. That's saying, the shares, let's say, are worth, I don't know, $32 a share right now. And I want to do a buy stop at 30. I'm waiting for the market to begin its drop. And as soon as it hits 30, that's where the stop will take place and become a live order. Now you'll start to make that purchase for me. Or a sell stop, when I tell you, I want you to sell my shares for me, but I don't want you to start selling them until they hit a certain number, in which case it would then become a live order. So it triggers at or through a stop price to become a live order. And then we just blend the two together, buy stop limits, sell stop limits. Here, I want you to trigger at a certain point, but then limit what you're willing to buy it for. Or a sell stop, trigger at a certain price to become a live order, but limit what I'm willing to sell for. So pretty easy concepts, all right? Just understanding the difference and the different ways that the trades can be entered. Now, one of the things that we're going to run into in the next unit is we're going to talk about something called the ex-dividend date. Okay, and the ex-dividend date, we learned 4 important dates. One of them is called the X date. We'll talk about it in unit 2, but essentially here's what happens. If my stock is trading at $16.50 a share, and the board of directors declares that they want to pay out a 50-cent dividend to its investors, then on the ex-dividend date, the stock will begin to trade X or minus that dividend, now trading at $16 a share. Now, we just talked about stops triggering an order and limits. What if this occurs? Does it affect my trade? Well, let's talk about that for a moment. Here we have an example of slobs in bliss, okay? So slobs would be sell limit and buy stops. This serves no purpose except to create a word. Okay, sell limits and buy stops. Well, I always say slobs, once a slob, always a slob. Slobs never change, do they? So once a slob, always a slob means that the ex-dividend date will not affect these two types of orders, sell limits and buy stops. However, Bliss, buy limits and sell stops, the I serves no purpose except to create a word. Bliss does change. I always say, think of your significant other when you first got with them and they snored or, they did something that you now find just utterly obnoxious, right? To the point of where you just want to smother them in their sleep. Bliss does change, doesn't it? So that being said, a buy limit or a sell stop would be affected if an ex-dividend date were to occur. Day orders, when I enter a trade, if it's a day order with no other qualifier, I've said nothing else, then it simply goes into place to create the trade. If, let's say, it's buy 300 shares of XYZ at $30 a share, well, if you only buy me 200 that day, then the other 100 is canceled at the end of the day. So any unexecuted portion at the end of the day will be canceled in a day order. A good till canceled or a GTC order is going to stay on the books until it's either filled or canceled. So if I say buy 300 shares of XYZ at 30 good till canceled, I'm saying even if you can only get me 200 today, leave it on the books to get me the 100 another day, tomorrow, next week, next month, next year, right? But understand that a cancel works like this. Either I'm going to call you and say, please cancel this order, I'm not interested anymore, or it's going to automatically cancel. You see, the house books will reset themselves on the last trading day of April and the last trading day of October each year. And then, of course, it'd be your job to properly renew that order if you'd like it to continue. Now, on top of whether it's a day order or a good till canceled, first let's talk about what we call our day orders. Our day orders fall into one of these two categories. It's either a fill or kill, or it's an immediate or cancel. Fill or kill says, if you can't buy me all 300 shares, don't bother buying any. Immediate or cancel says, if you've only bought me 200 shares today, that's okay. The other 100 can be canceled. In a good till canceled order, if I wanted to be all or nothing, then I would say all or none. You see, people confuse fill or kill with all or none all the time. Essentially, they mean the same thing, but fill or kill would be a day order. All or none would be a good till canceled. This lingo, this terminology is very important when someone is actually placing a trade. You can see how a mistake could be made if we use the wrong terminology. All right, guys, a few more slides just to finish up here. We've got our broker and we've got our dealer. As I stated, a broker is a lot like a real estate broker in the fact that they don't own any inventory. They're just assisting you in buying or selling. And a dealer already owns the inventory and they're buying or selling on behalf of themselves. Remember, I said they can never be both in the same trade. It would be a conflict. As a broker, sometimes they're also referred to as an agent or an agency. When a buy or a sell transaction is completed, then they would charge a commission to the customer. You see, a broker has little capital at risk, if any. Whereas a dealer also sometimes may be called a principal or a market maker. I'm sure you've heard of me. I've referred to them as the market maker earlier. As I said, they maintain inventory. They own the securities that they're buying and selling. And the profit that they make is known as the spread. It's the difference between the buy and the sell, the bid and the ask, right? Of course, as you can see, in understanding this, the dealer has a lot of capital at risk. Every share they buy or sell is now theirs or was theirs. All right, now often I'll say to someone, what is regular way settlement? And they usually say, oh, it's T+2. Well, I want you to understand that's technically not the correct answer. Excuse me, guys. So when I say what's regular way settlement, I would want you to automatically say, hold on, that depends. What type of security are we talking about? Because as you can see here, T+2, which is the trade date plus 2 additional business days before the settlement must occur, would be for corporate and municipals. So a corporate stock or a corporate bond, as well as municipal bonds, would be T+2. However, as you can see, the devil's in the details. For government, it would be T+1. This also includes options, T+1, except for, I always say there's the wild child in the crew, right? An equity option will settle T+2, but the other options like index options and currency options will settle T+1. Mutual funds settle based on forward pricing. We'll talk about that more in Unit 4. As I had stated earlier, stock normally trades in lots. 1 lot is 100 shares, 2 lots is 200 shares. However, in some cases, they might be traded in an odd lot, which just simply means it was less than 100. If both the buyer and the seller agree that they can go ahead and complete the trade today, I already have my stock certificates signed and ready to go. You have the cash ready to go. If we both agree, we could do what we call a cash settlement. Now, knowing that information, what is Reg T? Well, Reg T says that if the settlement does not occur by the date based on regular way, for government, through regular, or through corporate, through municipals, through options, whatever it may be, Reg T extends the time for 2 additional business days. Sometimes you'll hear Reg T referred to as T+4, trade date plus 4 days, or settlement date plus 2 days, S+2. But Reg T just simply says that the time for settlement can be extended an additional 2 business days if necessary. All right, so finishing up here, when we are going to do a trade, let's say that it is a stock trade or a bond, obviously, a stock or a bond, we have to endorse those certificates. And I always say, do it just like you would the title of a car. The name has to be exactly how it appears on the certificate for all owners. So we'll use my example. Let's say my husband and I, Emma Lay and Kevin Lay, own stock. Emma Lay and Kevin Lay must sign that stock certificate. It can't be Kevin and Emma Lay. It can't be Mr. and Mrs. Kevin Lay. There is something known as substitution or street name, in which case the power is still in the name of the broker dealer. It's actually not in my name, even though it's for my benefit, in which case there would be no need for me to sign it. The street name would take care of that. Sometimes we see them as electronic certificates instead of physical certificates, in which case we'd call that book entry. So street name, book entry, know the difference between those, okay? All right, and there's, we're not gonna go through the test prep questions because you're gonna have those in your checkpoint exam. So let's go ahead and make sure that we take our notes really well, make sure we do the takeaways that I've created for you. And that pretty much sums up anything that you may have been confused about on Unit 1.